Hi, my name's Belle and you are watching the first episode of the Macrodesiac Show. Now, I was asked a question by someone earlier today, and here was the email. I have a question regarding asset inflation. I saw a discussion on Twitter yesterday between Cullen Roche, an asset manager, Ari Paul and Nick Carter about the subject. Cullen said that the rise of asset prices isn't caused by the Fed expanding its balance sheet. He says that the rise in stocks is fundamentally driven. What's your opinion on asset inflation? Because I have heard contrary opinions on the subject. Okay, let's break this down then. So one side is saying it's due to fundamentals and one is arguing it's due to Fed activity. My opinion is that it is in fact a double-sided issue. You see, Cullen is right. The US is doing pretty damn well right now. Yeah, there are some cracks that might be showing, but overall growth is strong, unemployment is still low. And although we are probably in a bubble, I don't even think it necessarily matters anymore. Since where else is good enough to park capital outside of emerging markets, which tend to have more tense geopolitical and demographic issues? On the other hand, we have the denial from Roche that equities are going up due to Fed operations. Well, it's a bit silly in my view. See, when you're flooding the market with liquidity, and let me note, this is not all just due to the Fed, but it is a global central banking issue. You're causing a liquidity addiction. You're de-stressing markets to be able to continue to function as they had been, to essentially keep them on the same path as before. Let's take the view, for example, that the Fed began repo operations to be able to fund non-financials or hedge funds, their leveraged trades. Here's what the Bank of International Settlements said. Increased demand for funding from leveraged financial institutions, example hedge funds, via treasury repos appears to have compounded the strains of the temporary factors. Let's ignore the fact for a second that it was largely JP Morgan that began the stresses in money markets. I think the Fed showed their hand with this one, because regulations have caused specific issues in money markets and with bank reserves, and the Fed have understood that this could cause further issues. So is this simple appeasement a nod to helping out your Bridgewaters and your Rentecs? Maybe. The longer term issues with QE and low interest rate policy have created more permanent structural issues. Hinting back to what I mentioned about liquidity provision and the addiction to it, people have gotten used to a certain type of market environment. Remember when the Fed raised 25 basis points a few years back and everyone went nuts? Surely that is more evidence that the equities market rally has a fair amount to do with Fed policy. And surely the fact that firms such as Uber and WeWork are still around whilst being massive loss makers shows us that something is broken in the psyche of investors, whether VC, retail, or institutional. In my view, this chart is the most important though. This is the ratio between the Nasdaq Composite and the S&P 500. There's a few things to note. During the dot-com bubble, the Nasdaq increased in value massively versus the S&P 500. New tech firms increased the value massively, whilst value in the S&P 500 was more widely dispersed, which is why we see such a large increase in the Nasdaq relative to the S&P 500. Then note the QE years. The linearity of the grind upwards is important here, and is the clearest display of how Fed policy led to a massive bias or concentration to large caps. This is due to equity risk premium compression, also known as the decreasing amount investors get paid for taking on more risk investing in stocks. Remember that 40% of US firms make no money. Again, this is due to Fed policy. Lower rates lead to lower financing costs and a more aggressive search for yield. The former leads to firms being able to just about finance operations without going bankrupt, whilst the latter leads to an aggressive search for yield, pushing share buying into those large caps mentioned. So I think we should learn to reconcile the two issues behind the stock market melt up. Yes, US growth is good, so it's probably the best place to invest in globally currently. But also we should recognise that a lot of this is due to the aggressive injections of liquidity that the Fed are committing to and have committed to. Thanks for watching and join me next time.